Sources of Short-Term Financing, Chapter 8, Part 3. Foreign borrowing. Euro-dollar loan. Denominated in dollars and made by foreign bank holding to dollar deposits. Short-term to intermediate term and maturity. And LIBOR is the base interest paid on loans for companies of the highest quality. Borrow from international banks in foreign currency. Through foreign subsidiary, which converts foreign currency into dollars and sends to the parent company. Borrowing firm may suffer currency risk. Use of collateral in short-term financing. Secured credit card arrangements when credit rating of the borrower is too low. Need for funds is very high. And primary concern whether the borrower can generate enough cash flow to liquidate the loan when due. Uniform Commercial Code. Standardizes and simplifies the procedure for establishing security against a loan. It's usually filed against a non-property asset to use as additional collateral to take claim to that collateral. Account receivable financing includes pledging accounts receivable, factoring an outright sale of receivables. The advantage is permits borrowing to be tied directly to the level of asset expansion at any point in time. The disadvantage, though, is a relatively expensive method of acquiring funds. Pledging accounts receivables, again, is lending firm decides on the receivables that it will use as a collateral. Loan percentage depends on the firm's financial strength, credit worthiness. Interest rate is well above the prime rate, computed against the balance outstanding. Factoring receivables. Receivables are sold outright to the finance company. Factoring firms do not have recourse against the seller of the receivables. Finance companies may do all or part of the credit analysis to ensure the quality of the accounts. Factoring firm is absorbing risk for which a fee is collected and actually advancing funds to the seller at the lending rate. Asset-backed public offering. There's an increasing trend in public offerings of security backed by receivables as collateral. Interest paid to the owners is tax-free. Advantages of the firm include immediate cash flow, high credit rating of AA or better, provides corporate liquidity, and short-term financing. The disadvantage of the buyer, though, is risk associated with receivables actually being paid. Inventory financing. Factors influencing use of inventory for financing, which include marketability of the pledged goods, associated price stability, perishability of the product, and degree of physical control that the lender can exercise over the product. Stages of production. Raw materials and finished goods usually provide the best collateral, and goods in process may qualify only a small percentage of the loan. The nature of lender control provides greater assurance to lender but higher administrative costs, which includes the types of arrangements, which is a blanket inventory lien. Lender has a general claim against the inventory. Trust receipts or floor planning, an instrument that proceeds from sales and trust for the lender. Warehousing, a receipt issue. Goods can be moved only with the lender's approval. Public warehousing with a warehousing firm, and field warehousing on the borrower's premises. Appraisal of inventory control devices. Well-maintained control measures involve substantial administrative expenses, raise overall costs of borrowing, and extension of funds is well synchronized with needs. End of Chapter 8, Part 3.